Give us a sense of how global trade is fractured in recent years and what the landscape is likely to look like 5 or even 10 years from now.
The toothpaste is out of the tube and we're not going back. Now, we need to keep in mind that about 70% of goods trade do not involve the U.S. directly. A good portion of that is also under WTO. So we're not going to the past, but we still haven't really gotten to a future state. We're sort of in this dynamic environment right now. We expect a much more multipolar patchwork environment where you're going to have these various poles. Some would call them regions, but there's a pole around the U.S. for certain. There's a pole around China. There's a pole around the global south. Some would include the BRICS, but then if you talk BRICS, you sometimes involve China. But there's certainly a global south, and then there's a pole around the EU. These are very large trading poles, mostly centered around nations or custom unions. These are the patches. And the leaders today realize that that's where it's heading. So if you go out to 2030, a global platform, a global brand, or a global product will need to be tailored for these poles, whether it be for regulatory purposes or economic purposes.
What does this mean for CEOs of multinationals as we move toward this multipolar world with non-aligned middle powers, keeping everybody guessing? Will companies need to fundamentally restructure in order to thrive in this new world? And if so, what are the biggest changes on the horizon that CEOs really need to start wrapping their head around now if they're going to remain competitive?
Yeah, so I think it's most relevant for CEOs of global enterprises that have a footprint both in terms of sourcing, manufacturing, if we're taking goods, and in terms of markets, right? So you can be, single source, but serving a lot of markets. I think your question is most relevant for leaders of global enterprises. It means regionalization. Capital allocation will still remain at the center. That's not going to change because that's where you make the best trade-offs and the best decisions. But the empowerment, call it at the pole level, some would call it a region, but I call it a pole, would be enhanced. So full P&L accountability. You can imagine a world where a leader in a region or a pole owns the full value chain from innovation to delivery, owns the tech stack. We've already seen some evolution of the tech stack. So rather than sort of a central allocation of capital and then global platforms from one place emanating across the world, I think we're going to see much more accountability down the line outside of the CEO and into these poles and regions.
So can you give us an example of a fictional company, let's say a European automaker? How is that company going to need to adapt to this emerging structure that we're seeing for global trade?
A large European auto manufacturer is very dependent on China. One, production, supply chain, all of the components. So essentially the sourcing side, and then more importantly, the market side. Seeing the future of China is becoming increasingly important to our business. Given all the considerations, the dynamic in the U.S., the dynamic between the EU and China, the evolving regulations, we are better off, rather than having a global platform, to have a China for China, to contain our IP, to develop there, to have our own tech stack, to empower a P&L that's really owned in China for China, and also prevent the emergence of a potential competitor from China that would then capture share in some of the home markets that we have or some of the more traditional markets.
This feels like a good place to bring in Jean. Jean, which industries are likely to be most disrupted by this emerging multipolar trading environment?
Autos, like we just heard. Semiconductors. Next, tech splits at the speed of light. Pharma, too. Supply chains fragment. And honestly, consumer tech and media, they'll all feel it as digital borders harden.
Gene, I think you hit the nail on the head. I would add a few sectors. You didn't mention medtech. Medical technology is one that's very global sourcing, global markets that is being affected. And then you didn't mention apparel. Why apparel? Because the bulk of apparel manufacturing is in Asia, whether it's China or Southeast Asia or global south. And the bulk of the market is the U.S. and Europe. And it's very, very thin margins. So they're facing an existential crisis right now, particularly as it pertains to the U.S.